Assalamu alaikum and a very good morning to all of you. So today is the last day, that is day 5 of practice to pass session of paper FA. And in the previous 4 sessions, we have covered topics, incomplete records, we have covered the company accounts topic, we have covered the consolidation, ratios, and cash flow. So today we are going to cover the topic that is IFRSs. IFRS is one of the key area which is examinable in section A from the exam point of view. So you should have a clear concepts of these IFRSs. So there is a list of standards that is examinable in this paper. So starting from the first one, that is IFRS 15, revenue from the contracts with the customers. So IFRS 15 is actually the updated version of IAS 18 and IAS 11. So these two standards are now obsoleted and IFRS 15 replaces these two standards. IFRS 15 is all about the revenue. When we can record the recognize the revenue figure, how and how much to recognize the revenue figure. It's all about the revenue measurement and revenue that is recognized in the income statement and the treatment of unearned income. So according to IFRS 15, revenue is defined as the income arising in the course of an entity's ordinary activities. Ordinary activities means the prime business that you are performing into your organization and through which whatever income you are earning is your actual revenue. Revenue can be earned from the goods, or it could be earned from the services, or sometimes there might be a bundle transaction in which you'll be having the goods and the services at the same time. Some businesses earn the revenue from the services, some businesses earn the revenue from the goods, and some businesses provide a bundle transaction, which is the combination of goods and services. So IFRS 15 tells us the 5-step approach through which we recognize the revenue, in which the first one is identify the contract with the customer. So for all the contracts, for all the revenue related contracts, first we need to identify whether there is a valid contract exists or not. So there must be a proper contract between the buyer and the seller, in which the terms of the contract should be written, and the conditions and the consideration should be mentioned. After the contract, we need to see the performance obligations attached in the contract. What are the performance obligations? That now what are the responsibilities of each and every single party? What the supplier needs to do, and what is the responsibilities of the customer. Like suppose if you book a ticket for an airline in which you have to travel from for one way, then airline is responsible to transfer you from one location to another location. But if you book the ticket for the round trip, then airline is responsible for the two obligations. The first one is to transfer you like from the Karachi to UK, and from the UK to Karachi. So there might be three performance obligations in the contract. Performance obligations of the contract is dependent on the contract, and usually the customer needs to pay the consideration for the contract. So sometimes it might be the contract for the goods, it might be the contract for the services, the contract is for both the goods and services. Like if I'm selling the cell phone to the customers along with the internet connection, that shows that we are selling the goods and the services at the same time. Similarly, if I'm selling the books along with the lectures, that means that we are selling the goods and the services. So the third step is to determine the transaction price. The transaction price will be dependent on number of factors. So some part of the transaction price might be fixed or some part might be variable. Like for a airline ticket, the price is different if you select the one way or if you select the round trip. So as the performance obligations of the company is increasing over the period, the transaction price will definitely be increased. So if I'm teaching you one paper or I'm teaching you 6 papers, the fee will be different. That's all about the transaction price. Now, the fourth step is to allocate the transaction price on the performance obligations. Suppose an airline is charging a price of 25,000 for a local trip between two cities, Karachi to Islamabad, and then Islamabad to Karachi back. It has the two responsibilities. The first one is to bring the customers from Karachi to Islamabad and then from Islamabad to Karachi again. So if the price is 25,000, then you need to break the price between the first trip and the second trip, which might be equal sometimes or it might be a different amount. That is the allocation of the transaction price to different performance obligations. And then finally, step 5 says that you need to recognize the revenue when the performance obligation is satisfied. If the performance obligation is not satisfied, but you have received the amount in advance, then it will be your unearned income or deferred income. Like what accounting entries you will make if you have received the amount in advance without any delivering of the performance obligation, the accounting entry will be cash debit and deferred income credit. Like suppose today is 1st May, and suppose that we have booked the airline ticket from Karachi to Islamabad on 1st July. So when you book the online ticket, you need to pay the amount in full. So all you have done is to pay the full amount, but your traveling date is assuming in the month of October or July or any month. And right now we are in May. So the company will make an accounting entry of cash debit and deferred income credit. Suppose it's 1 lakh. So when the time passes and the company has delivered its obligation, at that time we can recognize deferred income debit and revenue. So when the unearned becomes earned, then you can recognize the revenue in the income statement. So next, we have been given two questions. Please do attempt these two questions. Then we will discuss after 2 minutes. Now this question, rep company is preparing financial statements for the year ended 30th September 2004. During that year, the rep acted as an agent on the behalf of the ZIP company and arranged a sale of the goods on 1st August 2004 at a price of 8 lakh, 80,000. So remember this point that in this case, you are working as an agent of ZIP company. So whenever you are working as an agent, you are only entitled to receive a commission. So the total amount of the revenue that you can recognize in your financial statements is just your commission, because you are an agent on the behalf of your principal company, which is ZIP company. So the sales of 80,000 was made during the year, but you can only recognize a revenue of 10%, which is 8,000. So as the customer has paid through the year end, so your entitlement is uh, you are entitled to receive the commission now, because you have earned the amount as you have delivered the performance obligation. So you can only recognize a revenue of 8,000 in your financial statement. Now the second question is, LOC company sells machines. The company sells machines and all other installation and technical support services. The selling price of each of the product is 750. Selling price of the machine is 750. Installation, we do the installation for $100, and there is a 1 year service arrangement for 120. So we sell three types of products. The first one is the machine, the second one is the installation, and the third one is 1 year sales and support agreement. Company purchased a machine along with the installation service and the service agreement on 1st October. The machine was delivered and installed on 1st October, and the service agreement also commenced from that day. So till December, how much revenue we can recognize? Do remember this point that the revenue related to the goods will be earned immediately as you have delivered the goods. So you have delivered the machine, so you have earned 750 in full. Then you have given the installation service, then you can recognize the full amount for the installation service. And finally, service agreement of 1 year. Out of this 120, you have provided the service for the period of October, November, December, 3 months only. So you can only recognize 3 months revenue in the financial statements. So for the 3 months revenue, it will be 30. This amount is 100 and this amount is 750. So that's the total amount of 880 that we have earned and we can recognize in the revenue. If the customers didn't come up with on first question, what amount we mentioned, kindly help. If the customer didn't pay the amount, is this the question is? Actually, it depends on the agreement that you have made with the customer, with your agent. So if it is dependent on the sales only, then you are entitled to pay the amount immediately after the sales, which could be a credit sale transaction. But if you have recognized or agreed the terms with the agent that you will only get the payment when the customer pays, so then in that case, you will not be able to recognize your commission income or it will not be earned till the time the customer has paid for the goods. Now moving on towards next two questions. I want all of you guys to do attempt this question and reply your answers in the chat box. Now let's solve this question. Which one of the following items has been included correctly in HAT's revenue for the year ended 31st March 2005? So which of the treatment is correctly included? Now, HAT company negotiated a sale at a price of 2 lakh on the behalf of the client, Rest Company, one of its clients. HAT is entitled to a 10% commission. Again, the question tells you that you are working as an agent and you are only entitled to receive the commission. HAT company is entitled to 10% commission on agreed sales price and has recognized revenue of 2 lakh in the financial statements. So now you can not recognize 2 lakh in the financial statements because you are working as an agent, so you can only work 10% of the sales, which is 20,000. So that's why this treatment is wrong. Second says that had entered into a contract to supply the consultancy services to CAP company for the 3 years term for a local total fee of 3 lakh. So 3 lakh is actually a fee of 3 years. The contract commenced on 1st July 2004. So till the year end, from July to March, it's been 9 months. July, August, September, October, November, December, January, February, March. Yes, it's 9 months. And a hat company recognized a revenue of 1 lakh in its financial statement. So you cannot recognize 1 lakh because 1 lakh is an amount of the revenue for the whole year. So you can only recognize 9 months revenue, 9 upon 12. So that's why this one is also wrong. Then on 1st November 2004, Hat Company purchased goods at a cost of 50,000 and sold those goods to FAR Company for 75,000 on 20th January 2005. Hat recognized the revenue of 75,000 on this contract in the financial statement. So I think this one is right because we have purchased the goods for 50,000, that is the cost of goods sold, and we have sold it for 75,000. Last one is on 1st December 2004, Hat purchased the goods for 25,000 and sold it for 50,000. So you can recognize the revenue of 50,000. So the right answer for this question is C. Next question is, which one of the following items is not the part of the 5-step approach for the revenue recognition as outlined in IFRS 15? So according to IFRS 15, first we need to identify the contract, then performance obligation, then allocate the performance obligation to the transaction price. Identify the contract with the customers. The first step one is identify the contract with the customer. The second is identify the performance obligation. Third one is the transaction price. Fourth one is the allocation of the transaction price. And fifth one is recognize the revenue when the performance obligation is satisfied. So, which of the following item is not a part? All contracts must be in writing. It's not the compulsory part of. So, identify the contract with the customer is step one. Recognize the revenue when the performance obligation is satisfied. Recognize step 5. Allocate the total price between the separate performance obligation in the contract. Allocate the transaction price between the separate performance obligation in the contract. This one is also the part of step 3, I think. So the right answer for this question is B. Now we have covered the topic IFRS 15. Now you guys are in a position to attempt questions from the IFRS 15. The next approach is IS 37. The next standard we are going to cover is IS 37, that is provisions, contingent assets, and contingent liabilities. Provision is a liability of uncertain amount or time. So provision is actually a liability where there is an uncertainty between the amount or the timing of the liability. Like suppose if we borrow a bank loan from a bank and they have paid an amount of 1 million along with the interest that you need to pay, and the repayment date is decided as 2 years. So if we borrowed a loan from the bank with an amount of 1 million and the time period is 2 years, then this is actually a liability, but it's not a provision because the time period is confirmed that after 2 years then you need to pay the amount, and the timing is concerned and the amount is fixed. So both the amount that you have borrowed 1 million, you only have to pay 1 million amount and interest amount. But there are certain liabilities like some sort of legal cases, some cases of warranties and guarantees in which the amount or the timing of the liability is uncertain. So these are the areas in which we recognize the provision. The accounting entry for the provision will be income statement debit and credit provision. Income statement debit and provision credit. Now this situation includes two things: the contingent liabilities and contingent assets. Contingent liabilities are possible obligations that arise from the past year. So contingent liability, the definition of the contingent liability is a possible obligation. So this is not a present obligation. It will arise or it can arise in the future. It arises from the past event or a probable obligation that arises from the past event, but the amount of the obligation cannot be measured with sufficient lag. Now, in comparison with this, the contingent asset means a possible asset that arises from the past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of an entity. Like suppose that you need to receive uh, the insurance claim from the insurance company. So if you need to receive the insurance claim from the insurance company, then there is a possibility that insurance company might give you the amount or it might not give you the amount based on some situation. So that's why we called it as a possible asset. Now remember this point, whenever there is a provision, provision will be recognized as a liability, and income statement debit means it will be charged as an expense in income statement. For the contingent liability, we need to disclose. Similarly, the contingent asset must be disclosed in the notes to the accounts based on the criteria which will be discussed later on. So there are some contingent liabilities and assets which should be disclosed in notes to the accounts. But whenever we have got the provision and the criteria are met, then it should be recognized in the financial statements. So this is actually the criteria. If it is met, then we can recognize the provision. Now, the recognition criteria is the provision should only be recognized when there is a present obligation. The provision does not work on the possible obligations, which could be a legal obligation or the constructive obligation. Remember this point that the constructive obligation means the obligation that arises from the historical past history. So the first thing is there must be a present obligation, which could be a legal means. It arises by the operation of law, or it could be a constructive obligation based on a policy or the history. It is probable. Probable means a chances of more than 50% that the outflow of economic benefit will be required to settle obligation, and the reliable estimates can be made to the amount of the obligation. So these are the three things. If it is met, then it should be recognized as a provision, and if the condition not met, then it will not be recognized as a provision. If the points are met, then we recognize the provision. Accounting entry will be income statement debit, provision. But if these criteria are not met, then you need to disclose. Disclosure means that you please do attend this question. So please solve it. Now the question says that Grass Company is reviewing its warranty obligation. Based on the sales during 2007, it was established that if all the lawn mowers sold required minor repairs, this would cost 1 million, where its major repairs were required at a cost of 6 million. Grass expects that the 75% of the lawn movers will have no faults, 20% will need minor repairs, and 5% needs major repairs. What provision should be made in 2007 and what accounting entry is needed to record it? What entry should be made in 2008, assuming the provision required then is 0.75? Okay, so first you need to calculate the provision. So for 1 million and 6 million. For the 1 million cost, the chances is 20%. So it will be 0.2 million. And for the 6 million major repairs cost, the chances is just 5%, 0.3 million. So the total amount of the provision that you need to make is 0.5 million. Accounting entry will be income statement debit and provision credit. That is the answer for first part. The second part, so what will be the accounting entry which should be required if the required provision is increased to 0.7 million? So you need to add further 0.25 million debit and provision credit 0.25. So now my provision amount is 0.75 million. In requirement C, it says that you need to reduce the provision amount to 0.3 million. So the accounting entry should be provision debit and income statement credit. So if someone wanted to reduce the provision amount, so from 0.75 to 0.3, the accounting entry will be 0.45 million. 0.45 provision debit and income statement credit. So whenever you need to increase the provision, the accounting entry will be income statement debit provision credit. And whenever you need to reduce the provision amount, the accounting entry will be provision debit income statement credit. Now, this is the most important table for IS 37 that you need to memorize, that there are four situations. That is the probability of the occurrence, means the chances of the payment. There might be a virtually certain case in which the chances of the payment is more than 95%. It could be a probable case where the chances of the payment is between 51 to 95%, possible case or remote case. So for the contingent liabilities, you need to make a provision in these two situations. But contingent asset can only be recognized when the chances of the payment is virtually certain. The probable case of contingent asset will be in the form of disclosure notes. The possible situation will be disclosure notes. Possible contingent liability must be disclosed by notes, and possible current asset should be ignored. The last one is the remote case. in which none has recognized anything. Remote case at it says, as the name suggests, that it is actually a fake case that has been made on you, and the chances of the payment or receipt is less than 5%. So you do not need to recognize any contingent liability or even asset. Now, these are the disclosure requirements you need to learn. It could be asked in the MCQs. Disclosure requirements of IS 37. The first is when there is a requirement to provide for the contingent liability, the liability is reflected in the financial statement. But all the provision in order to highlight the uncertainty. The movement in the provision is recorded in the financial statement each year. When disclosure is made by notes, the note should state the nature of the contingency, the uncertain factors that may affect the future outcome, and an estimate of the financial effect. So here we have two questions, which is test your understanding. I want you guys to solve it and reply your answers. So now let's solve this question. H company is currently in the middle of the protracted lawsuit, which is vigorously defending. The directors are reasonably confident that the action will not be successful, but are aware the opposite outcome is possible. So let's solve this question. H company is currently in the middle of the protracted lawsuit, which is rigorously defending. The directors are reasonably confident that the action will not be successful, but are aware that the opposite outcome is a possibility. It is difficult to quantify any potential damage, but the directors feel that they are unlikely to be exceed 50,000. How should the above be treated in the financial statement? So is it a contingent asset or contingent liability? So if the amount and time period is measured, then the answer will be A, because the amount is certain, the time period is certain. Second question is, how should a contingent liability and a probable contingent asset be accounted for? Contingent liability will be disclosed and contingent asset so possible probable contingent liability. So you can see here the probable contingent liability must be provided and contingent asset must be disclosed. The right answer for this question must be B. I hope it's done now. Before starting the next topic, I want to take a break of 5 minutes. After the 5 minutes, we will start again. Okay, now let's start the new accounting standard, that is IS 38. IS 38 is about the intangible assets. The basic definition for the intangible asset is an asset must be identifiable, non-monetary, and without physical substance. Without physical substance means no existence, no physical existence. Like you don't have ever seen the goodwill in your whole life. You cannot see the goodwill. You cannot see the software. How physically it seems. So goodwill intangible is one of the intangible assets. Copyright is one of the intangible assets. So these are the assets which are not physically existed. They are only on the papers, but they are not. They don't have any physical presence. Intangible assets are always non-monetary because they will give the benefits to the business, but they are not giving you directly cash. Like the receivables is a monetary asset, it gives cash directly, but intangible assets are all non-monetary. Identifiable asset means assets which are separable, which can be separately purchased or which can be separately saved. Like goodwill and any other asset like software. These are separable assets. You can buy the goodwill and the software separately, and you can even sell these two assets separately. So these are not interrelated assets. So intangible assets are always identifiable. They are non-monetary and having no physical substance. That's the basic definition of intangible assets. So development expenditure is one of the intangible assets. Goodwill is one of the intangible assets. Concessions, patents, license, trademark, brands, etc. There are lots of intangible assets available. So I study it tells you about the intangible asset. The first thing that you should know is that you're not allowed to record the internally generated intangible assets. Self-created internally generated intangible assets are not allowed to record on the face of the balance sheet. Like you can see a lot of business having a goodwill, but you cannot recognize that goodwill in its financial statements because they're self-created goodwill. But if someone has purchased that business along with the goodwill, then that person can recognize the goodwill in the balance sheet. So only the purchased intangible assets can be recognized, but internally generated are not allowed to record on the face of balance sheet. Now, the most important topic of this standard is the concept of research and development. Research means you are getting knowledge, whether it's possible or not. You are some planning stage, you are in the initial investigation stage that we are calculating whether this is possible or not. So research is actually a technical study to acquire some knowledge. And development is the application of the research findings. That's a very important thing. So whatever knowledge we have gained from the research, now it's a time to apply that knowledge on the development. So development costs can be capitalized if the criteria of IS 38 are met. The criteria is very simple, that if you know that we are going to incur the development cost, but it will give us the benefits in the future, and this development is practical, it's commercially viable, then you can record the development cost. The research means gaining the knowledge. Development means the application of the knowledge to manufacture a product or a service. Research costs will always go in the income statement as an expense. And development costs can be capitalized or it could be charged as an expense. But the development cost will only be capitalized when you know that the development will be completed and it will give you the benefits in the future. And whatever you are making in the development stage is practical and possible and commercially viable, then you can capitalize the development cost. Otherwise, you are not allowed to capitalize the development cost. Now, that's accounting treatment that all research costs must be charged as an expense. Development costs must be capitalized as an intangible asset if all the relevant criteria are satisfied. So development cost must be capitalized as an intangible asset if all the relevant criteria are satisfied. Now these are the criteria. The first one is the probable future economic benefits. Second one is the intention to complete the development. Intention to complete the development. Resources must be available and adequate. Ability to use or sell the asset means it must be commercially viable, technically feasible, and the expenditure can be measured reliably. So these are the points. When it is met, then we can capitalize the development expenditure. Development cost once capitalized and the company is going to take the benefits from that development expenditure, then it should be amortized over its useful life when the asset is ready for use. Now here we have a question for you guys. Please do attempt at this question and reply your answers in the chat box. Now, that can be incurred. Let's start the question again. Z company incurred the following costs during the year ended 31st August 2008. The first one is the 20,000 on the salaries to for the market research. So this will be the market research related cost. It should be charged as an expense. The second one is 1 lakh to purchase the machine to manufacture the components of a new car. It has been estimated as a useful life of 10 years. So this is the expenditure on the tangible non-current asset. So it should be capitalized and depreciated as normal. The third one is 25,000 on the material to manufacture a prototype. Prototype means that you are working on the development right now. 50,000 salaries related to its design and manufacture. And the new car is expected to go on sale in 2009. So this cost must be capitalized. So 25,000 plus 50,000 should be capitalized. So as the car is still in the process of development, therefore will not be able to amortize its cost. But when the development is completed and the product is available for the market, then it should be amortized over its useful life. IS-88 says that all intangible assets which are completed and ready for the use should be amortized, including the development expenditure. But only the goodwill which is exempted from this mechanism, goodwill will not be amortized. I hope you have read this point. Now here we have a question for you guys. Which of the following about the research and development are true? Which points are true? Which of the following statements about the research and development are true? The first one is the development expenditure shown in the balance sheet should be amortized over the period expected to benefit from the product or the service. Yes, it's true. Development expenditure shown on the balance sheet should be amortized over the period expected to benefit from this product or the service. So this point is right. Development expenditure must be capitalized if it meets the various criteria. Yes, right. Research expenditure is always written off. So all research expenditure must be charged as an expense in the income statement. So all of the above is the right answer for this question. Now this one is the last question for IS 8. After that we will start the new standard. So I want all of you guys to please do attempt this question by yourself. Please do attempt this question. I'm giving you 2 minutes. Now let's solve this question. The company has 3 projects. Project A, B, and C. A project to investigate the properties of a chemical compound. The project A is about the investigation, it's about the research, means it should be charged as an expense. A project to develop a new process which will save time in the production of the widgets. This project was started on 1st January and meet the capitalization criteria on 31st August. So this is a development-led project, but till for 31st August, the criteria are not met, so it will be charged as an expense. After 31st August, it will be capitalized as a development expenditure. Project C is about a development new project which will complete on 30th June. Related the cost in the statement of financial position at start of the year was 290,000. The 290,000 was already capitalized for this project. And in the current year, company has capitalized further 19,800. The production and sale of the new project commences on 1st September and are expected to last for 36 months. So the total amount of the capitalization is 290 plus 19,800. And now as this project is having a useful life of 36 months, we will charge a depreciation for this project, which it starts on 1st September, October, November, December, 4 months. So you need to charge the amortization or depreciation for the 4 months. So in the income statement, what will be recognized in the income statement? The research amount, the development expenditure when the criteria are not met, and when the criteria are met, and we are going to use that development, then its amortization will be charged as an expense. So there must be three items that is related to development expenditure. So you need to memorize this point that there are three items that will go in the income statement. The first one is the research. The second one is the development when the criteria are not met. And the third one is the amortization of the capitalized development cost. Now we are going to start the new standard, that is IAS 10. It's 11:25 now. I think we should take a break. Before starting this topic, we are taking a break of 15 minutes. We'll start the session after 15 minutes. Okay, welcome back after the break. Let's start the new accounting standard, that is IAS 10. The name is events occurring after the balance sheet date or the reporting date. So it is actually assuming the financial year starts at 31st January, at 1st January, and ends at 31st December. But practically, financial statements was made after 3 to 4 months after the reporting date. So if it is 2020, so suppose the financial statement will be prepared in 31st March 2021. So this period is a period of IS 10. Events occurring after the balance sheet date. Both favorable and foreign that occurs between the balance sheet date and the date when the financial statements are authorized for issue. So the time when the financial statements are formally prepared and the balance sheet date means the time at which the balance sheet or the statement was due. So between these two dates, IS 10 applies, and it says that whatever was happened between these two dates, it should be communicated to the shareholders. So if something is related to the previous year, this is called adjusting event. And if something is related to the next year, but it has so much significance and it should be communicated to the shareholders, then these are called non-adjusting. The accounting treatment is adjusting events must be adjusted in the financial statements of the previous period, and non-adjusting events must be disclosed in the financial statements. So all adjusting events must be adjusted, non-adjusting event must be disclosed. So we have got the few examples for adjusting and non-adjusting event. So all you need to do is to memorize these examples. An examiner will definitely ask you from out of these examples. Dividend proposed or declared after the balance sheet date but before the financial statements are approved should be disclosed in notes with accounts. So if the dividend was disclosed or declared till the balance sheet date, then it should be adjusted. A non-adjusting event that affects the going concern must be adjusted. Affects the going concern becomes an adjusting event. So these are the basic knowledge. Now this is the question for you guys. Which of the following events after the balance sheet date would now be classified as a non-adjusting event? So you need to identify which one is a non-adjusting event out of these four. Which of the following events after the balance sheet date would normally be qualified as non-adjusting event? Very good. A fall in the market price of the shares held by the entity as investments. So this will be a non-adjusting event. Insolvency of the trade receivable with the balance of 200,000 outstanding at the balance sheet date. It will be my adjusting event. Declaration of the dividend by the directors. Of the year-end dividend by the directors. So if the declaration was made at the year-end, this will be the non-adjusting event. Confirmation of the amount of damage awarded to an employee who sued for unfair dismissal after being sacked 2 months before the year end. This will be my adjusting event. So the right answer for this question is 1 and 3. B. I hope it's clear now. Now here we have two questions, that is test your understanding. So I want you guys to give your answers based on the questions. Now let's do solve this question. The following are the examples of the events which might occur between the balance sheet date and the date when the financial statements are authorized. So we need to identify which of the following are adjusting events. Losses on inventories as a result of the catastrophe, such as a fire or flood after the year end, is a non-adjusting event. The discovery of the fraud which shows the financial statements are incorrect, adjusting event. Evaluation of the property which provide evidence of the impairment in its value, which is my non-adjusting event. So the right answer for this question is D. Now, Robin Company has year-end 31st December 2008. The directors were informed on 27th February 2009 that a serious fire at one of the company's factory would stop production for the last 6 months to came. On 3rd March 2009, the directors of the Robin were informed that a major customer has gone into liquidation. The liquidator was pessimistic about the prospects of recovering anything from unsecured creditors. The financial statements for the year end 31st December were approved on 20th March. In accordance with IS 10 events after the reporting balance sheet date, how should the two events be treated in the financial statements? So fire will be considered. The right answer for this question should be C. Fire will be considered as a non-adjusting event usually, but in this situation you can see that it will stop your production for the 6 months. That means it will going to affect your going concern of the business. So that's why it is also adjusting. I hope it's clear now. Try this one. You are required to identify which is an adjusting event and which is a non-adjusting. Now, how should the above be classified under IS 10, adjusting or non-adjusting? Sale of a particular inventory line were poor during the second half of 2007. Director had hoped that the sale would pick up in 2008, but it's now apparent that the inventory will need to be marked down below its original cost. This is my adjustment. On 12th February 2008, one of the company's production plant was struck by lightning. The company will suffer a net loss of 55,000 as a result of this. Non-adjustment. Company is a valid customer with which owed A company 34,000 at the balance sheet date, although they were behind with their payments since the year end. Sales to the company were 12,000. The directors have just received notification that the company has gone into liquidation. So this will be considered as a adjusting event. This will be my adjusting event. So the right answer should be 1 and 3 should be adjusting. Now moving on to the next question now. IS2 inventory valuation. Now IS2 inventories. According to IS2, inventory should be valued at the lower of cost and net realizable value, whichever is lower. So first you need to calculate the cost of the asset or inventory, and then now for this case for the inventory you need to identify the cost and the net realizable value. So it is actually the application of the prudence concept. Prudence concept. Now how we can calculate the cost of the inventory? Cost includes the cost of the purchase, all the costs that we have incurred in order to acquire the inventory, but this type of the cost should not be included. Cost of the conversion includes labor cost, overheads cost, fixed cost, and other costs incurred in bringing the inventory to the present location and condition like carriage inward cost. So these are the costs that we need to add up in order to calculate the cost of the inventory. So now here is a question for you guys. I want all of you to solve it and give your answer in the chat box. Now, which of the following should not be included in valuing the inventories? So, labor cost should be the part of the inventory. Transport cost to deliver the goods to the customers. It should not be the part of the purchases. So, the right answer for this question is administrative overheads shall be capitalized 2 and 3. So, it should be C. On the factory plant is an overhead which should be capitalized in the inventory. Labor cost should be added in the inventory, but administrative overheads and transportation costs. So the right answer is C. Talking about the net realizable value means estimated selling price less estimated cost of completion and estimated cost of disposal. So by deducting the selling price from the cost of completion and cost of disposal, we got the value of NRV. Estimated cost of disposal includes any type of selling cost that is required to sell the product, and estimated cost of completion means any type of the cost that you need to incur to complete the inventory. So when you deduct estimated cost of completion and cost of disposal from the selling price, you got the value of NRV. So here is a question for you guys to calculate the net realizable value in this question. Yes, very good. Estimated selling price is 35. Less cost incurred to date and cost of the work complete items. The estimated cost of completion is 12. And the selling cost is 1 per unit. So when we deduct 13 from 35, the answer should be 22. Please do ask if you have any question in your mind. Now here is a test question for you guys. I want all of you to attempt this question and write your answer in the chat box. Now for the first question, an item of the inventory could be sold for $100 after it has been modified at a cost of 21. The company incurred a selling and distribution cost of 5% in the selling price of each article sold. The cost per unit is 45. Excluding the carriage inward of 2 and the production overheads of 17. So it will become my cost of the inventory. So 45, 55, 57. The cost is 64. Now you need to check the NRV. NRV will be 100 minus 21 modification cost and 5% selling price, which is 5. So 100 minus 26 will be 74. So inventory should be valued at whichever is lower. So the right answer for this question is 64. Very good. And the right answer, what about this one? Anyone has solved this one? Hero company sales, one line of inventory. Did any one of you have solved this one? If yes, write your answer in the chat box. Now, for the second one, Hero company sell one of its inventory at the year end. It has 200 units, having an original cost of 10 each. The cost will be 2,000, and had incurred a delivery cost of 120 in total. So the cost of the total inventory is 2120. They expect to these goods to sell at 13 per unit. So 200 into 13 per, that's my estimated selling price. And cost to sell is 10%. The NRV figure will be 2600 minus 260. So it will be 2340. The right answer will be 2120, whichever is lower. Now, you need to solve this question using the FIFO and do attempt this question. I'm giving you 5 minutes for attempting both these two questions. Now let's solve this question. At the start of the period, the company has 200. At the end of 200 units were in inventory, but 8 are damaged and are only worth 10 per unit. These are identified as having been a part of 11/11/2009 delivery, means the opening of this month. LAMP operates FIFO system for valuing the inventories. So, can anyone of you wanted to share the answer of this question? It's a FIFO. The company has purchased 100 units at 12 each, then 300 units at 3750 each, 40 units at 512, 60 units and 80 units. So the total purchase of the company is 100 plus 300 plus 40 plus 60 plus 80. So the total purchases of the company is 580, in which 200 is left at the year end, means the company has sold 380 units. So the closing stock should be this 100 will be sold in full and 280 will be sold from here. So the remaining closing stock will be at 12.5, 12.5 plus 40 units at 12.8 plus 60 units at 13 plus 80 units at 13.5. Twenty units into 12.5 plus 40 units into 12.8 plus 60 units into 13 plus 80 units into 13.5. And there are some 8 units which is having a value of 13.5 and it's now worth 12.10 each. So there is a loss of 3.5 in every unit into 8, 28. 2622 months. So the right answer for this question is B. This amount will become 2622 and there is a loss of 28 because 8 units are damaged and only worth 10 each. The inventory having a value of 13.5 are now reported at 10. So there is a loss of 3.5 for each unit. 3.5 into 8 units will become 28 and the answer will be B. Now, these are four different questions, but for all the four cases, 25% is the selling cost. So for the 10 units, the cost is 160, the price is 200 minus selling cost of 25%. So 25% of 200 should be 50. So its NRV will be 150. The first 10 units should be measured at 150. So 10 into 150 plus. Then we have 45 units having a cost of 240. Selling price is 360. So 360 minus 25% will become 270 minus 90. So it will become 180. So the NRV is 180. Again, NRV is less than the cost. So 45 should be measured at 180 plus 60 units having a cost of 40 each. These sell at 56 each and would now cost 48 if the additional units were bought. So 56 into 0.75. So it will become 42 NRV. So it should be measured at cost plus 50 units each having a cost of 8 each. Selling price is 8 minus 25% selling cost, which is 2, and modification cost is 2. Then NRV will be 4. Whichever is lower, 4. So that's my answer. 10 into 150 units plus 45 into 180 units plus 60 into 40, 50 into 4. The answer for this question should be 12200. So now we have covered almost all the accounting standards. The leftover is IS1, and IS1 is all about the formats of the income statement balance sheet, which was covered in company accounts, and the remaining standard that is left over is IS16, which has a revaluation concept, which was again discussed already in the company accounts by me. So right now we are going to do some practice from the exam kit. These are the answers. Please do solve these questions from 289 to 293. Question number 289 to 293. I hope you guys have covered these questions. You can reconcile your answer from the answer booklet. So, Alhamdulillah, we have successfully completed 5 to 6 topics in a 5-day revision. And I have shared my link of the WhatsApp group, my number with you guys. If you have any question in your mind, you can contact me on the WhatsApp. And thank you so much for your time. Please do maximum practice on both the cabinet and the BBP kit and try to attempt the examination as soon as possible. Before going to the exam tip is go and solve 4 to 5 mock exams, and 3 can be found from the education hub, and baki 2 extra mock exams. Once you attempted these 5 mock exams and then go for the CV, you will definitely pass the course. Thank you so much for your time. Take very good care of yourself. Allah Hafiz.